Hi Fools, welcome to another video from the Motley Fool. I'm Owen Benelak. Now it's been a mediocre year so far for Lloyds shareholders. The price has sort of just drifted about and it's down about 4% on the year, which after last year's rip-roaring 60% gain, it's obviously a little bit disappointing. And I can see why. If share goes up 60%, many people would be inclined to think that's more than enough for now. You know, the company is no longer in the bargain basement bin, that's for sure. People can see that the terrible debts of the past, the write-downs and whatnot, have kind of filtered through. Profits are on the horizon, dividends going to be resumed, government selling its stake, that's all good stuff. Some people probably think this is as good as it gets. I think that is a huge mistake. I think that is looking too myopically at the near term and forgetting how these banks used to be valued. And the measure I'm looking at is the price to tangible book value multiple. So the tangible book value is the value of the assets of the company if the whole thing was to be shut down tomorrow, wound the company up and you just walked away with the hard assets like, you know, the cash, what you get for the buildings, that kind of thing. And for Lloyds, it's currently trading at a tangible price to tangible book value of 1.3 times. So the share price is 1.3 times what the tangible book value per share would be. That sounds, you know, fairly reasonable. In the depths of the crisis, it was 0.5. So theoretically, you were buying a pound of assets for 50p back then. So you can see why people would think 1.3 is enough to be going on with. However, if you look back before the financial crisis, Lloyds actually peaked by this measure at 4 times price to tangible book value. So it's 1.3 now and peaks at 4 times. And it averaged about 3 times for years in the run-up. So, you know, if Lloyds was to get back to 4 times price to tangible book value, the share price would be, I think, I say doing the calculation, about £2.24. That would be a 3-bagger from here. If it was even to go to 3 times price to tangible book value, then that would still be a double. So you could have a double from here just to get back to where it was in the old days before the crisis. That seems like a fair bit of upside to me, and of course the book value might be growing as well as Lloyds' asset base grows. Now some people would say that's very unrealistic, Owen. Banks have to hold more capital now, they're never going to make so much profits, and who's going to trust a bank enough to pay that much for it again? I think there's a valid worries, but on the first point, yes, Lloyds can no longer stretch every pound as far as it would like in terms of lending it around to more and more people. They can't lever up as much as they used to in the old terminology. They have to keep more capital. On the other hand, they haven't got stupid competitors like Northern Rock writing terrible business that took market share from them and, you know, ultimately doomed that particular bank to its own destruction. So I think there's a bit of swings and roundabouts there. As for the trust element, people have a very short memory. I think if Lloyds is kicking out dividends every year and, you know, there's no more crises, we've sort of forgotten that weird thing that happened a few years ago, I think it could easily be the case that we get to a 3 times multiple. Probably it's possible that we'll even spike up to 4 times. If that happens, I think you'd want to sell your shares, but there's a lot of upside to come potentially. That's the bottom line.